Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to talk about the tax-free savings account, TFSA for short. I know some people did ask the question what that was, because I do talk about it. So we will talk about the tax-free savings account today. So if you're new to the channel, welcome. This is where we put $100 into a tax-free savings account to build a dividend portfolio right in front of your eyes. If you're not new, welcome back. And so because it is that we do that. Here's the proof that we did put in $100 into the tax-free savings account, which will be traded for Friday. We will purchase a stock on Friday, which is RBC, as you know, which is Royal Bank of Canada, ticker symbol, and that's the stock of January. And so we're going to talk about the tax-free savings account. What is it? A tax-free savings account is not a savings account as a lot of people might think it is. It is actually more of an investment account, which you can hold stocks, bonds, mutual funds, GICs in that account. And any growth that happens within that account is tax-free or tax sheltered. And so let's say you put in $5,000 a year, or sorry, $5,000, and that $5,000 turns into $15,000. Which in 2020 was totally possible with the amount of growth that we had in certain companies. That $15,000 is tax free. You don't have to pay capital gains tax on that. You don't have to pay any kind of those taxes. It's completely tax free. You do not pay any tax. And so that's the point of a tax-free savings account. Anything that grows within that tax-free savings account is tax-free, whereas anything that you bought, like a stock in a non-registered account that grows to $15,000, there are taxes that you probably have to pay on that. And I'm not a tax professional, so go seek your professional tax person. And so, yeah, so that is kind of the idea of a tax-free savings account. So the tax-free savings account was implemented by the Canadian government, because this is a Canadian account, in 2009 to encourage more or less Canadians to start saving. And so it was a new thing, and a lot of people didn't really understand it. So I know the first 2 years they had people over contributing and not really understanding the point of withdrawing and contributing, year after year. And so I'm gonna show you on this grid here, which gives you the contribution room for each year for that account. And so, as you can see, the first 3 years from 2009 to 2012, the contribution room annually was about $5,000. And it's only for people who are 18, except for BC. It's when you turn 19 in British Columbia, in that province. So, because that's their majority age or legal age. And so, let's say you turned 18 in 2009, your contribution room today, including 2021, because they did add another 6,000 contribution room in 2021, your total limit for contribution is $75,500. Okay, and that doesn't take into account any growth that happened within your tax-free savings account, if that makes sense. And so, if you turned 18, let's say in the year 2012. Your contribution room, you just subtract the last 3 years. Let me put it this way. If you were born in 1999, your contribution room would only be $23,000 last year out of the $6,000, so $29,000 total. So you're only allowed to put that much because you turned 18 in 2018, if that makes sense. But if you were born earlier than that, I think like 91 and on from that, you get the maximum contribution room in your tax-free savings account. Now, some people may think that that's not fair. They have more contribution room and things like that. But I'm going to explain something that is very, very interesting about a tax-free savings account. So let's say your contribution room is only $29,000, and that $29,000 turns into $90,000, which is totally possible with the fact that, coming off of last year, and we don't use our past history to to figure out what happens in the future for stocks. But last year, a lot of companies, 3x, 4x, 5x sort of thing. And so it is totally possible. So now you have $90,000 in this tax-free savings account. Okay, so the example is if you withdraw that $90,000 from the account, that is completely tax-free. The next calendar year, because the calendar year runs from January to December, you're allowed to put that $90,000 plus whatever contribution room that the government adds on to the tax-free savings account. You get the $90,000, let's say it's $6,000 plus the $6,000 as contribution room back into your tax-free savings account. So now your contribution room is about the same as somebody who has the full contribution max of $75,500. In fact, you have more. And so that is the cool thing about a tax-free savings account, is you can grow within the tax-free savings account as much as you want. And if you withdraw, let's say the $90,000, you can put that $90,000 back in the next calendar year. So let's say you do it in 2021, you withdraw the $90,000 tax-free. In 2022, you're allowed to put the $90,000 back plus whatever the government agrees for everyone to put in as contribution room. So $90,000 plus whatever the amount back in the next calendar year, which is super awesome. And I did mention it was tax-free, obviously. But there's a downside to that. So let's say, because you can actually lose contribution room in a tax-free savings account. Let's say you took $10,000, you put it in a tax-free savings account. And let's say the investment or the stock, plummeted and you lost 50%. You're down to $5,000, and you decide, I'm gonna withdraw this $5,000. I don't want anything to do with it anymore with this company. You actually take that $5,000 out. You've essentially lost $5,000 contribution room because you already sold off all the stocks, but the only value is $5,000. So you only withdrew $5,000. Does that make sense? So the $5,000 could go back in the next year plus whatever contribution room, but you'll never ever get that $5,000 that you lost because of the 50% downside of whatever stock it may be. So you can actually lose contribution room. So you have to be very careful with obviously what you buy, I guess, in the tax-free savings account. So hopefully that makes sense. And so that is a tax-free savings account. When it comes to dividends, because dividends usually count as an income if they're not in a tax-sheltered tax-sheltered account. If they're non-registered, you get taxed, on the dividend. In tax-free savings accounts, you do not get taxed for dividends. So let's, in our previous videos, we talk about dividends coming in. I'm not getting taxed on those dividends whatsoever. However, if you own United States or American stocks that pay a dividend, there's actually a 15% withholding tax within the tax-free savings account that they take right off the top of the dividend. And you'll probably see that in your account history. It'll be a withholding tax for the US. So that is not completely tax-free when it comes to American stocks, but Canadian stocks that do pay a dividend are completely tax-free. So that is pretty much a tax-free savings account. So remember, you can gain contribution room, obviously, with it growing. So let's say your $10,000 turns into $100,000. You take out the $100,000. You cannot put it back to the next year plus whatever contribution room that the government agrees to give you for the tax-free savings account. But you can also lose contribution room. So if you max out your contribution room, let's say it was 12,000 was your maximum, and you put in 12,000, you buy a stock, and that stock goes to half the price. Now your $12,000 investment is only worth $6,000, and you sell the stock. You're sitting on $6,000 cash. You withdraw it. That other $6,000 that made up the 12 is completely gone unless you grow, that $6,000 back up to the 12,000 to get that contribution room back. So you can lose contribution room. So be very, very careful with that, because I know a lot of people are probably confused about that, but you can actually lose contribution room. The last thing I want to make very, very clear is that it's when you turn 18. The year that you turn 18 is when you start your contribution room. You don't get any past contribution room. So let's say you turn 18 this year, in 2021. your contribution room is only $6,000. It's not $75,500. It's the year you turn 18 plus anything moving forward, not anything in the past. And so I just want to be very, very clear on that, because a lot of people think, oh, it's $75,500 for everybody. Not true. It's the year that you turn 18. So that is pretty much it for this video. I know it's a short video, and hopefully that explains things, because it's a lot of people are confused about it. It's not a savings account. It's more of an investment account. And anything that grows within the tax-free savings account is essentially tax-free. The best example I can give is, if you know those little sponge egg things that you put in water that turn into dinosaurs and it grows into like a T-Rex. Imagine that every year you're allowed to put in this egg and it grows into a T-Rex, and you take out the T-Rex out of the tax-free savings account, and you put that T-Rex back plus an egg that the government gave you. That's how a contribution room works. However, if your egg turns into a T-Rex and the T-Rex loses half its body, you're only allowed to put half the T-Rex bodies back into the tax-free savings account. I know it's a weird analogy, but that's how it makes sense to me. And so remember, you can grow your tax-free savings account limit to much higher than what the maximum contribution room is. For example, if somehow, I know there are a few Canadians out there that were able to reach $1 million tax-free savings account without paying the taxes, with strictly internal growth within the tax-free savings account. They have $1 million sitting in there, and of course they got investigated by the CRA and stuff, but they passed because there was nothing wrong with what they did. And so it is totally possible to have more than what the contribution room is in the tax-free savings account. And it is also very possible that you could lose contribution room in your tax-free savings account. So be very, very careful with the stocks that you pick and things like that when it comes to a tax-free savings account, if you want that perk of a tax-free savings account, because it's tax-free is tax-free. Don't ever have to pay taxes on it. And so that's a great thing. In some cases, I know some people think different, but and the reason they have limits on this, I just want to make that very clear, is because there's people out there that would probably just sock away as much money as they can in there, and they would start making money hand over fist without paying taxes, and that's kind of the way that they can control that, is to make maximum contribution room limits. They set limits on it. So this year, 2021, if you turned 18 in 1991 or earlier, your contribution room now is $75,500. They added another $6,000. If you turned 18 in 2010, your contribution room now is $69,500. And year over year, just subtract whatever was on the grid. So hopefully that does explain the tax-free savings account. It's something I wanted to get out for quite some time, but those are the most important things that you want to know about a tax-free savings account, is that you can lose money. Not lose money. You can definitely lose contribution room. You can increase your contribution room by having growth within the tax-free savings account. Anything you pull out of the tax-free savings account is tax-free, and anything you withdraw, you can put back in the calendar year, the next calendar year, plus the contribution room that the government allows. And so hopefully that makes sense. I know it was a short video, but that's as simple as it gets to trying to explain what a tax-free savings account is. And that's why I always recommend, in today's time and age, a tax-free savings account is kind of where you want to max out any kind of contribution first, and then, do other things as well. And so the tax-free savings account is the most beneficial way when it comes to increasing dividends or your portfolio value without getting taxed, without paying capital gains. And so hopefully that makes sense. I hope you guys did enjoy the video. And I know this week we had 3 videos come out, which is awesome. It's just the way it worked with the holidays and stuff. So we'll be back to regular schedule next week with 2 videos. But again, thanks for watching. I appreciate every single one of you, because I think we just hit 202 subscribers, which is awesome. 2021 is off to a great start. And yeah, we'll definitely see you guys in the next one. Bye.